Hello and welcome. My name is Linda Cook, and I am the president of Gilbert & Cook. We are a wealth management firm that is dedicated to helping our clients live a life of abundance. We are grateful and honored to have the opportunity to share this virtual event with you today. Confidence in a crisis. As you all know, our goal is to help our clients live a life of abundance. We've asked them to define what abundance means to them. And as you might guess, it's very personal. I can give you a couple of ideas on what people say. Health is always top of the list. We hope that you're healthy right now and taking good care of yourself. Family, another popular answer. Whether your family is near or far, or finding new ways to spend quality time together, and I'll let you define quality. Family is always important. And the third answer is typically something to do with financial security. Today, we are going to share some insights on the economy and explore some financial and investment opportunities. Even though we are in uncertain times, we believe you still have choices and in finding confidence, and we believe in finding confidence in those opportunities. Please know that everyone's situation is unique, and any strategy should be reviewed with your trusted advisor. If you are not currently a client, we're happy to provide you with a second opinion. Please go to our website. And many of you have already submitted questions, which we plan to answer today. If you have more questions, I encourage you to email info@gilbertcook.com. It's info@gilbertcook.com. Or you can also submit them to one of your staff members. Recently, the $2 trillion CARES Act was signed into law. The CARES Act was designed to help those most impacted by COVID-19. The CARES Act has far-reaching implications for many families and businesses. For individuals and families, we're probably all familiar with the stimulus payments, but one benefit that many are not talking about is the increased charitable deductions for 2020. As you might expect, many charities are in great need, and they're helping our communities. Not only is there a $300 above the line deduction for your adjusted gross income, but the Act also provides for unlimited deductions for cash contributions for taxpayers who itemize their deductions. So what does that mean? Individuals can elect to deduct donations up to 100% of the income that they earn in 2020, that's up from 60% in prior years. Now, one caveat to this is that families or that the contributions you make must be made directly to the organization, not to a private foundation or your donor advised fund. They have to go directly to the charity. And they also must be made in cash, not appreciated stock, like we've done in the past for our clients. Retirement plan distributions are also, some leeway is given there in the CARES Act. People who have inherited retirement accounts can suspend distributions in 2020, thus resulting in lower taxable income. If you have a required minimum distribution, which many times is referred to as an RMD, that also has been suspended for 2020. RMDs are the distributions that you're required to take from your qualified retirement account once you turn 72. In prior years, that was 70 and a half. Many people are using those distributions for cash flow and are part of your tax planning. So everyone's situation is a little bit different, and make sure that you discuss that with your advisor as well. Another popular strategy worth utilizing is a qualified charitable distribution. However, this year, we might want to rethink that strategy. Due to the unlimited charitable deduction, allowed for charitable gifts or cash gifts. IRA holders can utilize cash distributions from their IRA or from their qualified plans and take them as a distribution and then pay that to those proceeds to your favorite charity. As long as you're itemizing your deductions, you can deduct that. So that's a much larger deduction than you've been able to take in the past, which was limited to $100,000. Retirement plan distributions, if you're under 59 and a half and you've been affected by COVID-19, which we hope you're not, you can take a penalty-free withdrawal from your retirement account up to $100,000. That's typically the penalty if you take a withdrawal under 59 and a half is 10%. So that's about a $10,000 tax savings. But keep in mind that that you still have to pay income tax on that. The withdrawal is just your penalty is waived on that. So business owners, I've listed a couple of items on here for business owners, and I'm not going to go into great detail on those business owners. There's a lot of very complexity around the rules. So I encourage you to talk to your banker, talk to your CPA, talk to your advisors about what the best strategy is for your business. And finally, there's some timely tax and investment strategies I'm just going to touch on. One of them is tax loss harvesting. We've all heard that when the market's down, don't sell, you'll lose money, and it's not a real loss if you don't sell when the market's down. So why would you want to sell? I'm not recommending that you sell and get out of the market. So hear me on this. I'm not telling you to get out of the market, but what I am doing is challenging your thinking around what a capital loss might be. I believe that's an asset that you can stick in your pocket and use later on. Those losses, so if you had a security that you sold that happened to be down, and that security was down, you'd lost money on it, you can take that loss and use up to $3,000 of that loss against your ordinary income. But if there's more than that, you can use that against future capital gains. That loss can be carried forward indefinitely. So that's an important point. And it's important to take a look at your investment portfolio and see is there some losses we can harvest. And you also want to be it's very important on what you go back into in the market. You can't go back into the same security in a 30-day period. So you'll want to buy maybe a similar security if you still want to participate in that particular area of the market, but you don't want to buy the same security right away. Once again, talk to your CPA, see what's right for you, talk to your advisor. We encourage you to do that. Roth IRA and conversions. What's a Roth IRA conversion? Well, it's basically taking money out of your current IRA and moving it into a Roth IRA. Some of the benefits of doing that is you're trading tax deferral inside your IRA for tax-free growth in the future, also tax-free withdrawals. So Roth IRAs, you're not required to take RMDs and as the original owner, and a Roth IRA, I believe, is a great legacy asset. A few negatives: you have to pay the tax now when you make that conversion. So whatever amount you decided to convert from an IRA to a Roth, you have to take as a taxable income in the year that you do that. Additionally, once you do it, you can't change your mind. So if the market goes down further, or you can't back it out or change your mind about it. And then the other thing that is uncertainty for all of us is the government might change the rules on us someday. No one knows what that might look like. So it's a little bit tricky. Make sure you're talking to your advisor about that strategy as well. And finally, front loading your contributions. If you're a long-term investor, there are some good opportunities when the market is below its recent highs that we've seen. I'm encouraging my clients to go ahead and make make their retirement plan contributions, any 529 for grandchildren or children. Those contributions can be made now rather than waiting later in the year. Those can be made at any time. So this is a good time to turn it over to Chris Cook, our Chief Investment Officer at Gilbert & Cook. Hi, Chris.
Hello. Hi, everybody. All right, thanks, Linda. So welcome, everyone. Thank you for taking some time to join us. As we started into the economic understanding of this pandemic, there was really only 2 months ago, we had 3 big and 1 latecomer, but 3 big real-time scoreboard numbers that everyone could watch. So first being, of course, the number of new coronavirus cases. That information was in front of us either through the press conferences or through the Johns Hopkins site every day. Initial jobless claims, so initial unemployment claims where people are filing for unemployment the very first time. That's a weekly data point, and so those were coming fast and furious. We're going to talk more about that later. And then the pricing of the stock market, since that is fortunately or unfortunately traded every minute between 8:30 and 3 p.m. Central Time every day. We are getting constant doses of here's what the world thinks, or here's what traders think the prices of stocks should be. And all those pieces of information, those numbers were horrible. You know, more new cases, more new deaths, more initial jobless claims, and a stock market, especially in the early stages of this thing, that was falling very precipitously. A latecomer on this list is the GDP number. I'll make a couple comments on that, but just as of last week, we got our first taste of what first quarter GDP was for the United States. So coronavirus obviously is the reason around the current market turmoil that we've had. I will not try to do any modeling around coronavirus cases and mortality rates. I think it'd be a disservice to healthcare professionals if I tried to forecast that. But I will speak today on the trajectory of the economic impact. Hopefully you saw our writings back in mid-March on how does a healthcare crisis become a financial crisis, and really a race to see if cash could outlast Corona. And then we saw it play out. Forced shelter in place, forced business shutdowns, business revenue loss, job losses, economic contraction, debt and rent delinquencies, state and local government revenues strained, et cetera, and we've seen where that's led. So here we are in the midst of a recession. Let's call it what it is. No one can say the U.S. wasn't due for one after 10 plus years of uninterrupted economic expansion, the longest in history. But recessions, quite frankly, are a normal matter of course in the economic cycle. We know that, but we didn't know that this would be the reason. We've never done this reason before. And a forced closure of vast parts of the economy was the result. So how bad is this recession compared to others? The numbers are big, and I'm going to start with that GDP measure that's new to us. We got our first GDP measure last week, like I said, first quarter of 2020. Output of goods and services in the United States was down 1.2%. We produced 1.2% less than we did in the fourth quarter of 2019. That, of course, is 4.8% on an annualized basis, which is how the headlines read. Whenever we announce GDP, we always annualize the 1 quarter number. So our estimates now for second quarter of 2020, April, May, June, are even worse yet. So depending on how quickly the economy reopens, probably down somewhere between 20 and 30% on an annualized basis. Pretty big range, but also pretty huge numbers. That would mean the first 2 quarters of the year, first half of 2020 in real terms, would have contracted somewhere in the range of 6 to 9%. So to put that number in perspective, if that's how it pans out, we won't know what second quarter GDP was until July. But if that comes true in the first half of 2020 was a 6 to 9% contraction, the entire 08 and 09 contraction was 4%. So it took six quarters for that to play out back in 08 and 09 crisis. in the first half of 2020 is going to be a number that most likely far surpasses that. So from let's try to couch it this way, because that's a little bit of a scary number. From a single quarter perspective, if that's the level that we hit in the second quarter, we're talking about U.S. GDP output basically retracing ourselves to 2016 levels, 2016 GDP levels. So here's probably a pretty good point in time where we talk about the shape of a recovery. You know, every letter in the alphabet has been represented yet so far, and lots of people are willing to talk about this. But where I think we're heading right now is that 2016 reference point that I just mentioned is artificially low. So we're held down by mandatory shutdowns, and even if consumers do have money to spend, and we'll talk about that here in a little bit in terms of the fiscal stimulus that's supporting those households, where is there to spend it? What are we going to go do? Where are we going to travel? Where are we going to go out to eat? So even with money in our pockets as consumers, it's hard to find a place to make good on creating an economy out of that. So from that 2016 reference point that is artificially low, what we see from here is sort of a base camp recovery, where we quickly climb back to, I'm going to call it 2018 GDP output numbers, kind of get used to that new altitude, get used to a new normal in terms of if economic impact or economic activity is a little muted as we slowly go back to our favorite places, and then slowly from there ascend to a full recovery and new highs for economic output. So that's one of the things that I want to make sure that I hit on today. That's probably one of the biggest risks for investors in the current during the current crisis, is we're going to have to be patient, especially in terms of stocks, or patient in terms of our expectations around GDP output. Most likely we're going to have to absorb a few punches waiting for the world to figure things out. And of course, there I'm talking about volatility. The stock market, quickly, very, very quickly priced in a short-lived recession. And we saw that. We're going to talk about pricing action in the stocks here in a second. Let's shift to that slide. So a harsh contraction, but short-lived. If the opening of the economy or the resurgence of the coronavirus takes longer than anticipated to control that virus, or that instead of reopening, we get into reclosing down the economy, possibility, the markets will probably be reacting negatively to that in the short term. So V-Day is very much an unknown date in relation to the coronavirus timing. So this is a question from our participants today. Several of you asked, how in the world have stocks reversed course so strongly since the March 23rd low? And to paraphrase, don't the markets know what's going on in the world? And I think that's a pretty fair question in today's environment. On the heels of, and we're starting to look at the red line on the left being, of course, the near term of the 2020 crisis. And we'll get into the subsequent recovery. We know that April was the best month in U.S. stocks since 1987, and that, of course, is on the heels of one of the worst months in March of that year. So let's talk about trying to move forward into what some of this market action is going to be. I'm going to try to make a few notes here on the screen. So this bear market drawdown, what we've done here is we wanted to take the current crisis and retrace our steps on some prior fairly near-term crisis. And of course, here I'm talking about 9/11 and the recession around the terrorist attacks, and then also talking about the recession of 08-09. So blue lines in the middle, that's 07 through 09, a peak in the market down to a trough. And here we're talking about the way the chart works, talking about the S&P 500, and the timeline along the bottom is trading days. So number of days that the market was open to create that action. So for the market period around what ended up being the 9/11 crisis, of course, we're coming out of Y2K, coming out of the dot-com bubble. We're already heading into a slowdown in the economy and most likely a recession. then the terrorist attacks hit and pushed the US even further into that recession. That's the the line that goes the furthest, or the green line. So the way each of the crises work, they start at 0%, meaning what was the high point in the market, and then show over their time frame how far they traded down. So in this first market here, the first S&P 500 line, where we retrace our 08 and 09 steps, it took about 17 calendar months, or 360 trading days, for the market to retract by 55%. And as you also see in here, there was a few head fakes along the way. So several different series of 10% bull market bounces off of some of those bottoms that happened on the way to the market, making that new low. When we go to the crisis events surrounding 9/11, it takes even longer for that to play out. The downturn in the market here, down 47% at this particular point, that took 30 months, took 2.5 years for that to play out. So definitely our theme, and as we talk through things today, and we look at the 2020 crisis, from this starting point, we hit a new high in the markets on May 19th. From that high point to down 34% on March 23rd, it took 22 trading days for the market to hit that low. And we'll talk about the subsequent recovery here in a second. So what happened off of that low? As we switch to next slide, now I want to talk about the recovery that happened coming out of those low points in these past crises. So maybe the very first thing we talk about is how quickly and how condensed that recovery has been in this near-term 2020 timeframe. So from that March 23rd low, rallying up to where we are today, and I was going to get a fresh line here. We're up more than halfway back to where we started, and I think we're up more than 20% off of that bottom. But again, in a very short time frame, from that bottom to now, March or May 5th is only 6 weeks. So very compressed time frame. So what happened in there? Well, the Fed and the Treasury and the White House and Congress stepped in a very big way. Linda made mention of a couple of those programs that had stepped in. So in trying to compare or trying to contrast where are we in this particular crisis, we're all sharing in this COVID crisis. How does that compare to things that happened in 08, 09? How does it compare to things that happened during 9/11? So in maybe a page out of the 08 and 09 playbook, and in a scope far exceeding that, the Fed and the Treasury stepped in with two major courses of action. So the first one was to backstop and even purchase investment grade debt. There was a big rush to cash as things in the economy, and they talked about shutdowns, and they started to get CFOs and CEOs anticipating economic shutdown. There was a big draw on those lines of credit. So they learned in 08 and 09, if I have a line of credit at the bank, I better make sure it's in my bank account and not just a promise from the bank. And so I think that's a repeat of 08 and 09. And the Fed also purchased some of those securities that it was difficult to find a market for. The Fed stepped in and bought those treasuries to create that liquidity for the market. Being very opportunistic, quite frankly, on the Fed side, they expect to make money on each of those programs, whether they're backing somebody else's money market or they're buying those securities outright. Our Federal Reserve expects to make a return on those investments. And I'll say, from what we've seen, they did a good job shoring up those credit markets and making sure that, as it's been referred to, the plumbing of our economy, meaning the movement of money around, didn't stop. The second side, which I think the stock market is equally interested in, is the fiscal spending. So this one we have to pay for. I think the Treasury is in the market this week for $3 trillion of debt to a couple things there. One, they have to cover operating expenses for tax payments that they didn't receive. We all should have paid our taxes normally on April 15th, and those are deferred until July 15th. So there's no money in the coffers of the U.S. Treasury. but also to pay for these fiscal stimulus programs. So whether it's the $1,200 per household, $500 per child, paycheck protection program, or extending unemployment insurance, there's been some direct aid to hospitals and municipalities. That's where the checkbook is really open, and we're going to have to borrow money and figure out later how we're going to pay that back. Probably not a time to be cheap. We're trying to keep a bridge on the economy and a bridge on these businesses and hospitals and states and local municipalities as we bridge ourselves to that economic recovery. So sky's the limit. The government has come out and said that the sky's the limit. They're going to reserve no cost in getting that back out. And the cost of that roughly right now is budgeted at about 2.4 trillion. There's probably some mitigating factors where they'll actually collect some income tax or Social Security tax on those during that time, but it's got a big price tag on it. But in terms of seeing that fiscal stimulus announced, that to us is probably the most major impact for the quick turnaround in the stock market in that 6 weeks leading up to today. And we had a good day in stock markets again today. Again, the compressed nature, if you contrast that with one, let's talk about 07, 08 first. It took us 17 months to hit that bottom, and then from that bottom, a slow climb out to get all the way back to zero, to get back to those levels where we started from back in October of 07. That timeline of recovery is 3 calendar years. It's basically 3 years in terms of that recovery. 9/11 was off by 47%. It hits bottom in October of 02 and starts the long road out of making its way back to them. Took 4 years. So in all of those cases, in the two past crises, what you saw is a long road into market downturn and a long road of economic recession, and then a very, very slow climb back out. And then here we are in our current state, where everything so far has been compressed into this very, very short time frame. Again, I think the risk to investors here is it too far, too fast? Have we counted on a very quick economic recovery and quickly everybody getting back to work and opening back up the economy? Like I said earlier, if anything takes longer than expected, stock markets may react very negatively about that. So I want to make sure I frame this correctly, but as investors, and especially when we're talking about the stock market here, and you've heard us say it many, many times, you have to be focused on the long-term nature of things here, even in the course of being right in the middle of a pandemic. So for a second, I'm going to ask you to take yourself back to September 11th of 2001. In some ways, that crisis era feels the same in terms of the impact on our psyche, on the nation's psyche. We were in the midst of something that had never happened before, the terrorist attacks. We knew it would change life forever. We didn't know how, but that was very scary. But what transpired out of those darkest days in terms of the market of the future? Here's some all-American food for thought as we go through that. And again, what I'm talking about here is we're right here at this, we're actually about here in terms of that low point on September 11th, because it did take it took the market another year post 9/11 to hit bottom. But here's what was happening in the U.S. stock market and in the U.S. economy right after 9/11 of 2001. So Apple introduced the iPod, not the iPad. Apple introduced the iPod on October 23rd, 2001. The market cap of Apple at the time was about $7 billion. And for you Iowans that are on the call right now, that's not a lot bigger than Casey's General Stores is today. Netflix and Google, again, I'm back in the fall of 2001. Netflix and Google had been invented, but would not go public until May of 2002 and August of 2004, respectively. Facebook. Mark Zuckerberg was 17 years old, hadn't even been a thought yet. Amazon would turn its first ever quarterly profit in the fourth quarter of 2001. They made a penny a share. traded for less than $7 with a $3 billion market cap. It's 390 times larger company today than it was then. Back on just prior to 9/11, General Electric was the largest company in the S&P 500 by market cap. Exxon was third largest, and IBM was eighth. So long time S&P members, but not quite the same companies that they were back there. So like I said, that was the lay of the land right after September 11th of 2001. And like I said, the market would not bottom for another year after that. Very, very rough time again for the nation's psyche, but the real opportunity was the long-term opportunity. It was not trying to time the bottom. It was not the U.S. stock market will probably always get us when we try to time that bottom. But the U.S. stock market is a rejuvenating mechanism. So the reason I went through that list of, quite frankly, companies that had very, very little impact on the U.S. stock market in 2001 and are having a huge impact on the U.S. stock market today, those new ideas displace the old. And not because of 9/11 specifically, but because the economic world evolves and adapts, and stocks have historically been the best way to participate in that. So I want that to be somewhat encouraging, because most of us here can remember where we were during 9/11, again, how it made us feel and what it changed for us as a country. But it also created, and the stock market, I think, will do it again, creates massive opportunities in the future as it reinvents itself. So back to our current realities, the interesting thing about market pullbacks is we need to reset expectations, and in this case, we're resetting expectations upward. I want to make sure I said this before we finish. So the start of 2020 saw Gilbert and Cook with relatively conservative stock and bond expectations. We were at historic highs in stock markets and prices and historic lows in interest rates. So in anticipation of, at some point, a stock pullback, probably a recession, I will be the first to admit I did not think the U.S. would be in recession in 2020, and I'm sure I told many of you that, and debated and argued that point in 2020, and I couldn't be more wrong. I did not anticipate the virus and the pandemic. But given that, all stock categories, and even on the bond side, everything that isn't U.S. Treasuries, those debt categories, now have better long-term expectations from where we sit today on a go forward basis. So in this pullback, just like in those prior pullbacks, you do hit the reset button to some degree. And I know a lot of people on this call, we had good, what we feel were very good asset allocations and a balance between risk and reward going into this crisis. And in periods of irrational exuberance or periods of crisis and downside like this, that's probably not the correct time to be changing your investment stripes and looking at new ways to go about things. So I said at the onset that initial jobless claims were one of our scorekeeping mechanisms for how we thought the coronavirus, especially coronavirus resulting in economic shutdown and shelter in place, how is that going to impact the economy? So this was one of our, as much as we have it on an economy our size, one of our real-time numbers. So in order to frame what's happening in the last couple months, I went back to the two crises we were just talking about on the earlier screens. So going back to the 9/11 timeframe, and I'll look at one of my slides here. Initial unemployment claims means that all across the country, people are going to their unemployment office and filing for an initial time, their very first time, they're filing for unemployment insurance. So it's, in this case, a good measure of who lost a job and who is going to rely on the backstop of some unemployment claims. This period of time is kind of September 01. In one single week, we peaked above 500,000 people that filed for initial unemployment claims, and some pretty high numbers around and subsequent to the 9/11 terrorist attacks. Incidentally, unemployment rate peaked coming out of that recession, peaked in June of 03 and peaked at 6.3%. So the unemployment rate in June of 03 was 6.3%. We fight our way back, we get to a more normalized initial claims. And this particular peak right here goes back to the 08-09 crisis. So that's kind of February and March of 09, where we get some big spikes above 650,000 for several consecutive weeks. And each of those data points is a one week time frame. But ultimately, the unemployment rate in the US peaked at 10% in October of 2009 after that series of initial jobless claims. So you can see there, in terms of those past crises, bigger spikes in people going to file for unemployment claims the very first time. Now let's take a look at 2019. And the first thing we need to do is scale this chart, 2019, 2020. I went back to the beginning. This marks the beginning of 2019, and you see a very anemic initial jobless claims. In a healthy economy, somewhere around of our size, 160 million people workforce, about 200,000 people, 300,000 people a day are consistently filing for unemployment claims. That 09 peak would fall about right here. So in that previous slide that we looked at, whether it's 9/11 or whether it's 08-09, this is the previous peak for any 1 week where people filed for unemployment claims. And right away, in what we saw beginning in the middle of March, when the shutdown started, is in 6 consecutive weeks, and that's the graphing of this line going up, peaking at 6.9 million people. But in 6 weeks, 3.3 million, 6.9, 6.6, 5.2, 4.4, 3.8 million people, 30 million people filed for initial unemployment claims at their state's unemployment office. That's a really hard number to fathom about what could create a scenario like that. If you're a risk manager and you're trying to say, hey, what would drive the unemployment rate in April of this year? What would drive the unemployment rate to 15%? Oh, that's crazy. How could we go from 3% to 15%? Well, now we know what the answer is. It's a coronavirus. So inside these numbers, though, I want to paint a little bit of maybe a different picture than it looks like on the surface, because what we truly believe here is that those jobs are not gone. It's not like we were coming out of 08-09 and when we said back then the economy lost 8.5 million jobs, they really were gone. Those businesses went away, those jobs went away, and people had to reallocate resources and reinvent themselves. We're more so in the camp right now that these jobs are in hibernation, but not gone. So when safe for workers and customers, there's an immediate need for those job duties and an immediate need for the workers to fill them. Both of those things are ready to go. We're not short workers and we've got openings and jobs. We need both of those things will be redeployed very quickly. Part of the government stimulus program was also to increase the weekly unemployment benefits by $600. And this, it's not coincidentally, but when we talk about unemployment insurance historically and the way it was designed, it replaced on average about roughly 40% of a worker's income if they did happen to lose their job. And they had filed for unemployment, they could expect to receive about 40% of their wages back. In most states, that $600 increase, and by most I mean 36 states, makes it 100% replacement of job wages or greater than 100% of job wages. So that stimulus to add that $600, and the reason for the $600, I believe, is that on average, if you take $600 times all the unemployment claims, it would make the average replacement wage equal out to about 100%. So in certain cases, in certain states like Massachusetts and New York, Washington D.C. area, it's not 100%, but in a lot of cases, especially outside the more densely populated areas, it's greater than 100% replacement. So we feel that there's two things there. The individual households, the impact will be much more tolerable because there'll be unemployment insurance ultimately making their way back into those people's pockets. So rents and mortgages will be paid. But the headline number here, and also people are resourceful if they're getting paid more to stay home versus go back to work, there's probably people that might say they'll allow that to happen as long as they can. But that'll be short-lived. And if those jobs truly are in hibernation, and those businesses stay open and those workers have a place to go back, we very quickly could see that number roll over the other way. What we have seen, again, inside the data, this is the initial claims. There's another weekly reported number that's it's a week in arrears to this one, but continuing unemployment claims. So what that means is that somebody that has previously filed for unemployment and it comes around to the next week, they haven't found a job or they haven't gone back to work, and so they file again to continue their unemployment claims. So what we're seeing just in the last 2 weeks, and we'll get another data set. Like I said, this is sort of like the stock market. It's the real-time read on the jobs market. On Thursday morning this week, we'll get another round of data set. In the last 2 weeks, what we saw is more workers went back to work. So people that had filed for initial claims didn't go back for more unemployment insurance. More people went back to work than the new people that were filing, in this particular week or this particular week. More people were going back to work than were filing for new claims. So hopefully we found a plateau and a very quickly diminishing number. Because when you think about that level of unemployment and that number of people, you're kind of talking about 1932 Depression era unemployment approaching 25%. And I will say, or I want to remind everybody, there was no unemployment insurance program back then. Not until FDR signed the Social Security Act in 1935 did we even have unemployment insurance. So the economic impact to that many people losing their jobs and not having a very quick to react Congress, White House, Treasury, Fed to put some fiscal stimulus into place to hopefully what bridges a short gap to when everybody can get back to work. So we're probably mostly focused on that continuing unemployment claims number. That'll tell us more quickly or more accurately how many people are going back to work versus how many people are still on the sidelines. But again, don't forget that hibernation where we need to bring these jobs back out of hibernation and reinvigorate the economy as quickly as we possibly can. So again, the risks, of course, the whole economic resuscitation takes longer than anticipated. I think the stock market is in love with the stimulus programs. It's in love with Dr. Fauci. It really wants there to be a good result and some good news around the corona case. And let's remember why we headed into this. All of these data points, especially stock markets, unemployment, debt, all these other measuring sticks that we can use, all of those are secondary derivatives to the coronavirus. That is the sole enemy going on in this drama. And so if you eliminate that enemy, and we've seen it when Gilead had some good news about a treatment drug, not a vaccine, but a treatment drug, you actually saw the markets react very positively to that. So again, the risk is that economic resuscitation takes longer than anticipated. Risk is a virus relapse. How much will people tolerate? I think they have a lot of quarantine fatigue already, and so will there be somebody's not muted there. As we go back to work, will we be willing to trade possibly an increase in cases, and we know from that a loss of life? What's going to be people's risk tolerance for that when, if we were sheltering in place, we could be saving those people? So that's a real big variable for especially stock markets going forward. I want to make sure I mention this too. Dividends in certain areas are a risk, certain sectors. Energy, we've seen certain providers start to cut back on, of course, their CapEx, but also their dividend payout. And so the retail real estate sector also cutting of dividends, trying to conserve cash until people get back and make sure that they can be collecting the rents that they're owed. So those are two big risk factors. When a market resets, of course, the dividend rate rises as long as the dividend payout rate stays the same and you're dividing by a smaller stock price. Those rates have gone higher. But we do see that as at a risk where the market in total might get trimmed back by, it may be a 10% reduction. So instead of 4% payout ratio on large cap value stocks, maybe it's 3.6, just depending on how those individual stocks have the ability to pay. So again, a risk for investors. And just so you didn't think that I forgot, election day is 6 months from today. So just thought I'd remind you, if you don't want to go to your polling place, make sure you get your absentee ballot filed. But I love this slide from two different perspectives. One, there will come a time in the next 6 months where we are ultra focused on the election and what should have happened, shouldn't have happened in two candidates debating for the next presidency of the United States. But what this graph really speaks to is it's not a knock on presidents having little impact on the markets, although I am happy to make that argument from time to time. It's really an argument around market timing. So what we have illustrated here is going back to 1961. JFK is its first year in office. So from 1961 to 2019, 59 years of presidential politics. Let's go with the big number on the right. If you put $10,000 into US large cap stocks in 1961, January 1st, and then opened up your statement on, or maybe opened up grandma's statement on the 31st of December in 2019, that 10,000 with price and dividends reinvested had grown to about $3.25 million over that 59-year period. And again, time is on our side there. 59 years is a long time to be invested in U.S. large companies, but again, our seed capital was only $10,000 there. When you look at the two graphs down below that pale in comparison, it's not really, again, meant to be a knock on, hey, Democrats did a better job than Republicans. It's how both of those pale, and again, it's really a market timing slide. Because this goes along with people saying, I'll get back in when it's safe, or I'll be invested in stocks when I feel more comfortable. Sometimes people base their comfort level on what political party's in power. So in periods where Democrats were in power, and there is only 28 out of the 59 years, so you're invested for a much shorter period of time. And it actually did pretty well. In all of those cases, each of those administrations moved the stock market forward, or the stock market moved forward during their administrations. And so you were making money through all that period of time, but you were in only 28 years out of the last 59. Republicans had a rougher time. They had more years, 31 of those years, but the George W. Bush administration was right there, which of course had both the 9/11 market and the tail end, the worst part of the 08-09 recession. So George W. is the one outlier administration out of all those, where in an 8-year period, U.S. large companies got battered around pretty good and did not make any money. So that drags down that number. But really, again, it's a nod toward not market timing, and it's a nod back to my 9/11 or the stock market immediately after 9/11 and how that rejuvenates and regenerates itself. This is a perfect depiction of that. So what are our opportunities here? I'll close things off, and we'll get to a few other questions if we have a few more minutes. These are the opportunities. Know yourself as an investor. So lean into your Gilbert and Cook team to help determine that. Like I said earlier, extreme pessimism is no better a time to change your stripes and your investment objective than periods of irrational exuberance. So know your course and keep on it as best as you possibly can, and we will help you do that. So what do we believe? We believe that American ingenuity and resilience will persevere. The world, healthcare, and science communities are smarter and better funded than at any time in the history of the planet, ever. We believe that the debate is around when the virus will be contained, not if, and that is our only enemy, as we've said earlier. So if the virus is contained, then all these other things we're talking about can begin to dissipate. We believe that life will be different in the same way that 9/11 changed many protocols. Quite frankly, forever, this pandemic may also. And the other thing that we believe is we'll figure it out. The stock market will reinvent and regenerate itself. Some of the brightest minds on the world are involved there. And every day, all across the world, people get up, they go to work, and they make their lives and the lives of their families better. And they make their communities better. And we invest in that. So I'm sorry we had I'm thinking of an aside here, and I didn't plan on saying it, but we lost a client 2 days ago to the coronavirus, and we're cruising along, and we're thinking that we don't want anybody's business to be impacted, we don't want anybody's life to be impacted, but a longtime friend of ours caught the virus and passed away relatively quickly. So it puts in perspective a little bit what we do for a living. I mean, yes, we're trying to help you take care of your money, but to keep that optimistic view and keep that view toward that regeneration and that rejuvenation, that's really what we're all about, and we're gonna stay focused on that, no matter what the world throws at us. So sorry about that, but with that, maybe I'll bring Linda back, and we'll have a chance to do a few questions.
Thanks, Chris. Thanks, Chris. Well, actually, we got quite a few questions that came in, and I think probably since our hour is up, I think we're going to go ahead and address those in an email format back to those people, and we will be sending out.
We plan to share those answers. If there's some specific questions, we'll put those out on the blog and make sure that we share that back with everybody, because there are some good questions. I didn't realize that we were out of time. I apologize.
No worries, no worries. Thank you so much. Thank you for joining us today. It's truly an honor, and we're grateful to have this opportunity. Be safe, be healthy, enjoy your families.
Thanks, everybody.